Welcome to the Auto Intelligence Podcast, where we bring you sharp takes on the auto industry's most relevant topics every Tuesday, Thursday, and Saturday. I'm Steve.
And I'm Claire. We're part of the Auto Agentic team, and we're excited to dive deep with you today. Happy Saturday, everyone.
That's right, it's Saturday, and today we're going to go a bit deeper into how recent events are affecting what the rest of the year will look like for the automotive industry. We've got a lot to unpack today, a perfect storm of challenges and opportunities that are reshaping the sector.
No doubt about it, Steve. I've been reviewing this fascinating analysis by Barry Hillier, and it really paints a picture of an industry at a crossroads. There are 5 major trends we're seeing, and they're all interconnected in ways that will impact everyone, from manufacturers to consumers.
Let's jump right in with what might be the most immediate challenge facing North American automakers: these new tariff policies. The 25% tariffs on vehicles and parts from Mexico and Canada are sending serious shockwaves through the industry, aren't they?
They certainly are. What's particularly concerning is how these tariffs are threatening to unravel decades of North American integration that was built under NAFTA and, more recently, USMCA. I was struck by Carlos Tavares from Stellantis calling it unprecedented chaos across their supply networks.
And we're seeing real numbers attached to this disruption, too. The analysis suggests these measures could raise consumer prices anywhere from $3,000 to $10,000 per vehicle. That's significant enough to potentially reshape buying behaviors across the market.
Right, and Ford's Michigan assembly plants are looking at cost increases of about 25% just on parts they source from Mexican suppliers. Then there's the situation with Chinese EV manufacturers facing even steeper barriers, 100% tariffs on imported vehicles, plus those technology restrictions.
What I found fascinating in the report was this quote from Sam Fiorani at Auto Forecast Solutions, noting that these tariffs ironically might be accelerating Chinese automakers' plans to establish manufacturing bases right here in the US.
That's a great point. Take BYD, for example. They already operate that electric bus facility in Lancaster, California, and now they're reportedly looking at locations for passenger vehicle production. Their vertical integration gives them a real edge here, with 75% of components produced in-house.
The regulatory uncertainty seems to be the biggest headache for manufacturers right now. We've got potential elimination of the $7,500 federal EV tax credit under the current administration, alongside California's increasingly strict emission standards. How are companies supposed to plan long-term in this environment?
It's nearly impossible. Jonathan Smoke at Cox Automotive really nailed it when he said uncertainty is the enemy of long-term planning. And we're already seeing the effects. Their forecasts suggest US new vehicle sales could drop from 16.3 million to 15.5 million units if these tariffs stick around.
Let's shift gears a bit and talk about what might be the surprise success story of 2025, the remarkable comeback of hybrid vehicles. After years of being somewhat overshadowed by pure EVs, hybrids seem to be having their moment.
The numbers tell the story. Hybrid sales grew 19% year over year in 2024 and are projected to surge another 23% this year. Toyota must be feeling pretty validated right now, given their long-term commitment to hybrid technology.
Akio Toyoda confirmed that hybrid demand is actually exceeding their production capacity, which is remarkable. Their hybrid sales jumped 53% last year, hitting a record million units. I think it speaks to consumers wanting fuel efficiency without dealing with range anxiety or charging infrastructure challenges.
And the economics make a compelling case too. Plug-in hybrids are now costing 5 to 15% less than equivalent EVs in China, where they've gained significant market share. In the US, the average EV transaction price last year was about $55,500 compared to around $48,400 for hybrids.
The projections for this year suggest hybrids could capture about 15% of the U.S. market. That's roughly 2.4 million units, compared to EVs at 10%. For some perspective, hybrids accounted for just 6.7% of sales in 2023, so that's a dramatic shift in consumer preferences.
What I find particularly interesting is how hybrids provide regulatory flexibility. They allow automakers to meet emissions targets without going all in on EVs, which seems like a smart hedging strategy given all the uncertainty we just discussed.
Speaking of smart strategies, let's talk about how automakers are rethinking their supply chains. After all those disruptions, from semiconductor shortages to pandemic-related bottlenecks, resilience seems to be the new watchword.
No question about that. Stellantis' chief supply chain officer, Stefano Boeri, put it perfectly when he said resilience is now as important as efficiency. They've committed over 11.2 billion in semiconductor agreements through 2030 to secure long-term access to those critical components.
And yet, despite improvements since that crisis period of 2020-2022, analysts are forecasting another shortage of mature node semiconductors either late this year or early next year. It's like, we're constantly playing catch-up with these supply chain vulnerabilities.
The Chinese manufacturers definitely seem to have an advantage here. BYD's vertical integration approach, producing 75% of components in-house and even selling chips to competitors, gives them tremendous flexibility. They can bring new EV models to market 3 times faster than traditional automakers.
European manufacturers are taking a different approach, right? They're increasingly reshoring component production to reduce dependence on Asian suppliers.
Indeed, we're seeing Volkswagen move some battery cell production to Germany and BMW expanding drivetrain manufacturing in Austria. Inventory strategies are evolving too, with automakers stockpiling critical components rather than relying on just-in-time delivery.
The report mentions climate disruptions as an emerging threat as well. Apparently, flooding risks threaten about 23% of automotive suppliers. When you combine all these factors, tariffs, supply chain restructuring, climate risks, analysts estimate it could raise vehicle prices by 6-8% in North America.
That's a significant increase, especially as we're finally seeing inflation cool to under 3% last year. It's going to put additional pressure on affordability, which connects back to why hybrids are gaining popularity. They offer a more accessible price point.
Let's talk about the bigger geopolitical picture. This ongoing decoupling between the US and China is reshaping global automotive trade flows and investment in pretty fundamental ways, isn't it?
Without a doubt. Michelle Krebs from Cox Automotive described it as the emergence of distinct automotive spheres of influence. The connected vehicle technology ban and those EV tariffs are aimed at curbing China's dominance, yet Chinese EV exports continue growing at 30% globally.
Mexico's position has become particularly complex. They're benefiting from nearshoring, but also facing pressure to limit Chinese inputs under U.S. scrutiny. Several Chinese automakers have scaled back Mexican investments due to anticipated rule of origin reforms.
Meanwhile, Southeast Asia and India are emerging as alternative manufacturing hubs. Thailand and Vietnam are attracting significant EV battery and parts manufacturing, while India's using production-linked incentives to position itself as a connector economy for US-aligned supply chains.
European manufacturers seem to be caught in the middle of all this. Stellantis reported a 37% year-to-date sales decline. Volkswagen is down 23% amid these US-China tensions. Though interestingly, Renault is bucking the trend with 19% growth by focusing on Europe and emerging markets.
That's fascinating. Speaking of emerging markets, they're creating some bright spots in an otherwise challenging global picture. Chile, Turkey, and Argentina are leading EV adoption this year, driven by local manufacturing and innovations in off-grid charging solutions.
So with all these seismic shifts happening, what strategies are proving successful? The report outlines 4 key approaches being deployed with varying degrees of success.
Toyota and GM seem to be taking the diversified powertrain approach, hedging their bets with balanced portfolios spanning traditional engines, hybrids, and pure EVs. Toyota's hybrid leadership has proven particularly valuable as EV adoption slows.
Though that approach does carry significant R&D costs that strain margins. I was interested to see that GM's dual-platform strategy with Honda enables cost-efficient production of both hybrids and EVs, reducing R&D expenses by approximately 30%.
Then there's the software-defined vehicles approach. Tesla continues to lead in autonomous technology, while traditional OEMs like Ford invest heavily in AI-driven factories. Those cybersecurity vulnerabilities remain a significant concern with these connected vehicles.
Subscription models are gaining traction too. Volvo's Care by Volvo targets corporate fleets with 12-month hybrid and EV plans, while Toyota's Kinto bundles hybrid leases with insurance and maintenance in Japan and Europe.
What caught my attention was how these subscription revenues can be classified as services in many jurisdictions, providing tax advantages compared to traditional sales. In the EU, they may qualify for lower VAT rates.
And finally, we're seeing auto companies leverage tax optimization strategies. Volvo relocated EV production from China to Belgium to bypass 27% EU tariffs, saving approximately $3,000 per vehicle.
So what does all this mean for the road ahead? It seems like success is going to require unprecedented agility, balancing regulatory compliance, cost management, and evolving consumer preferences across increasingly fragmented global markets.
You've hit the nail on the head. We've got Ford delaying its next-generation F-150 Lightning to 2028, while companies like Hyundai are gaining market share through strategic hybrid investments. The policy landscape remains the biggest variable. If these tariffs remain throughout 2025, Cox Automotive warns that higher prices and border disruptions could upend their 16.3 million sales forecast.
For consumers, the implications are mixed. While hybrid options provide affordable efficiency, overall vehicle prices are projected to rise 6-8% due to tariffs and supply chain restructuring. The potential loss of federal EV incentives would further impact affordability in the electric segment.
What's really striking to me about all this is just how dramatically the landscape is changing. The automotive industry that emerges from 2025 will look fundamentally different from what we knew before. Companies that can navigate these turbulent waters with flexibility and foresight are the ones that will thrive.
I couldn't agree more. The ability to adapt quickly to changing regulations, consumer preferences, and supply chain realities will separate the winners from the losers. It's going to be fascinating to watch how this all unfolds.
Well, that wraps up today's deep dive into the automotive industry at this critical crossroads. Thanks for joining us on this Saturday edition of our podcast. As a reminder, the Auto Intelligence Podcast drops every Tuesday, Thursday, and Saturday with sharp takes on the auto industry's most relevant topics.
Today's episode was produced by the human and AI teams at Agentic. Agentic is a pioneering AI-driven platform transforming the automotive retail industry with intelligent, adaptive solutions designed to help dealerships streamline operations, optimize sales performance, and elevate the customer experience.
You can find out more about Agentic, an agentic AI company, at autoagentic.ai. Make sure you like, comment, and subscribe to stay up to date on all our latest episodes. Thanks for listening, and we'll catch you next time.